In 2025, rising geopolitical tensions and the U.S.-China rivalry triggered an exodus of Japanese and Taiwanese firms from the mainland. On November 21st, Canon's shutdown of its Zhongshan factory marked a turning point. Online statements cited the shrinking laser printer market and surging Chinese competition as key reasons. Despite attempted adjustments, failure was inevitable. After 24 years, Canon Zhongshan, a wholly owned subsidiary manufacturing office equipment, ceased operations. As one of the city's largest employers, it had been a vital pillar for the local economy and job market. Thousands of workers were suddenly unemployed. Shocked employees took to social media, questioning if politics, not just finances, forced the closure. One lamented, "Can a Fortune 500 company just vanish? Are we supposed to deliver food or drive ride shares now?" In 2019, we felt secure. Now the anxiety is unbearable, one worker shared. On X, blogger Asia Finance noted that companies facing financial trouble usually attempt layoffs or pay cuts first, not immediate total shutdowns. He suggested the closure aimed to avoid political uncertainty. This isn't isolated. It signals the end of foreign capital's dominance in Chinese manufacturing. A November 26 Nikkei Asia survey showed Japanese firms are cutting reliance on China due to soaring business risks and falling market share. Tensions between Tokyo and Beijing have amplified these risks. Japanese investment in China plunged over 30% in the first half of 2025. Recently, Sony Xperia's WeChat service account displayed a cancellation notice, and the mobile section vanished from Sony China's website. Older product pages became inaccessible, and Sony Xperia's Weibo hasn't updated since March. An insider explained that declining phone sales and service adjustments reflect a broader reevaluation of Japanese operations in the country.
中国市场的脾息一阵沸定，日本开外代笔名士感到越来越不安全。Some families, even those with Chinese citizenship, have begun returning to Japan. Across industries, from automotive to retail, a massive withdrawal wave has begun in 2025.
Mitsubishi Motors' exit is notable. In fiscal year 2024, sales in China and Asia plummeted 53%, moving only 7,000 units. Facing mounting losses, Mitsubishi announced in early 2025 it would cease vehicle production, closing its joint venture factory in Changsha, Hunan. Panasonic continues investing in EVs in Shanghai, but is slashing traditional consumer electronics. In 2025, it announced it would stop making low-end microwaves and rice cookers in China, shuttering production lines in Tianjin and Hangzhou. Toshiba also scaled back. Its products are now sold under private labels. Sharp hasn't fully exited, but saw market share for phones and TVs drop below 0.5%. In 2025, Sharp quietly removed smartphone lines from its Chinese site, shifting focus to medical equipment. Tamura Corporation, with 11 bases in China, announced in November it would start producing sensors in Saitama, Japan, and sell off a Chinese joint venture. They plan to cut China production by 30% by 2028, expanding in Mexico and Europe instead. Reports suggest TDK is shifting battery production out of China to Haryana, India by late 2025. A Dalian employee confirmed the output cuts, noting the severe impact on local service workers. In 2025, Family Mart closed nearly 100 northern China stores, retreating to the Yangtze and Pearl River deltas. Yoshinoya halted expansion in lower-tier cities, pivoting to franchises to mitigate risk. This follows sharply escalating China-Japan tensions.
PM Sanae Takaichi recently suggested self-defense forces might intervene in a Taiwan emergency, angering Beijing. China responded with warship patrols, travel warnings, threats against seafood imports, and economic pressure on Japanese businesses.
The diplomatic fallout hit businesses hard. Jetro reported over 20 canceled bilateral engagements, shattering corporate confidence. Sensing growing insecurity, many Japanese firms are accelerating their shift to Vietnam and Southeast Asia. Professor Ichiro Kurogi noted Takaichi won't retract her comments. He observed that Beijing's aggressive actions have backfired, actually boosting her domestic support. The more pressure China applies, the more united the Japanese people become. Meanwhile, Japan and Taiwan are tightening ties. On November 15th, they signed an intel sharing pact. Economic cooperation is surging, highlighted by TSMC's new Kumamoto factory, which began production in April 2025, cementing a semiconductor alliance against Chinese pressure. In Taiwan, Japan's firm stance boosted public support, leading to calls to buy Japanese seafood like scallops. The government even lifted all post-Fukushima food import restrictions, signaling full solidarity. President Lai Ching-do posted a video enjoying Hokkaido scallops and Kagoshima amberjack, asking, "What are you eating?" He highlighted his lunch of local squid and tamagoyaki made with Taiwanese eggs, symbolizing the strong friendship between the nations. In the first half of 2025, Taiwanese capital outflows hit historic highs, while investment in China collapsed to just 2.7%. On November 18th, Kinpo Electronics, a fixture in Dongguan's Chang'an town for 30 years, announced its shutdown. Once employing 10,000 people, Kinpo completed liquidation by 2025. Operations moved to Thailand, joining a growing list of closures in Chang'an, including major names like Lite-On, Fujitsu, and multiple footwear and dyeing factories. Kinpo's exit began over a decade ago. In 2015, it quietly moved lines from its Fenghuang plant to Thailand, cutting 3,000 jobs. Founded in 1996 by Taiwan's Kinpo Group, the massive facility initially covered 170,000 square meters. Producing for giants like HP and Canon, the company is leaving due to U.S.-China trade tensions, rising geopolitical risks, and soaring labor costs. The business environment in China has simply become too challenging. Surveys show 63% of exiting Taiwanese firms chose Southeast Asia. In 2025, Apple shifted 40% of iPhone production to India, shaking China's contract manufacturing sector. The once dominant Foxconn-led clusters in the Pearl and Yangtze deltas are hollowing out. As production shifts, Foxconn faces empty lines. Its Zhengzhou hub is reportedly eerily quiet, with a deserted business district, sparking withdrawal rumors. Speculation is even mounting that Foxconn Shenzhen plans to dismantle its production lines. Is Foxconn collapsing? It's not just them. Factories in Suzhou, Kunshan, and Dongguan have stopped hiring and are laying off veteran staff. Reports suggest the Longhua campus is decimated, with over a dozen departments completely wiped out. Operations are paused, likely due to plummeting orders. Workers report being let go immediately after shifts end. Those still employed face zero overtime, limited to basic 8-hour days, drastically cutting their income. Managers suggest uncertainty will last until mid-December. On October 27th, videos showed crowds of Foxconn workers resigning. Reports indicate a massive restructuring is imminent, putting nearly 100,000 jobs at risk under the guise of an industrial upgrade. This alarms the entire sector. Sources say the iPhone Air, released in October, sold a dismal 50,000 units in 2 weeks, a sharp contrast to the iPhone 17. Consequently, Foxconn is dismantling lines and expects to cease that production by late November 2025. The intensifying U.S.-China rivalry accelerates this. Trump's America First policy pushed for supply chain diversification, urging allies to exit China. Caught in the tech war crossfire, Taiwanese companies have been particularly quick to leave. On November 27th, Wealth magazine chairman Xi Jinping noted that deteriorating China-Japan relations hastened the Japanese exodus. He highlighted a historic shift. In October, Taiwan's exports to the U.S. surpassed those to China, confirming that U.S. tariffs are effectively reshaping the global industrial map. Xi noted a structural shift. In October, exports to the U.S. hit $21.1 billion, 34% of total, while China trailed at $14.3 billion. In the first 10 months of 2025, exports to the U.S. surged 63% to $151.6 billion, overtaking the $138.9 billion sent to China. This marks the first time U.S. exports exceeded China's. Taiwan's trade surplus with the U.S. surged to $112 billion, far surpassing last year's total and eclipsing the $63.1 billion surplus with China. The data confirms an accelerating U.S.-China decoupling.
Xie emphasized Taiwan's ICT and semiconductor sectors are increasingly tied to the U.S., driven by investments like TSMC's $165 billion stateside. Meanwhile, China's Ministry of Commerce reported Q3 2025 foreign direct investment plummeted to just $8.5 billion.
That's a 51% drop quarter over quarter and a staggering 92% fall from the 2022 peak. This collapse reflects shattered confidence in China's economy. Once a global capital magnet, China now faces empty industrial parks and soaring unemployment. U.S.-based expert Cheng Xiaonong warned that China's economic miracle is over and recovery is unlikely. He urged the public to prepare for a prolonged downturn. As foreign businesses flee, the unemployment rate is hitting historic highs. Cheng warned structural unemployment could trigger social instability. Consumer confidence is at rock bottom, with retail sales growing just 3.2% in Q3, far below pre-pandemic levels. Wallets are empty, spirits are broken. This isn't a cycle, it's a full-scale collapse. With real estate in crisis, supply chains broken, and jobless graduates rising alongside early retirements, the country faces a generational nightmare. While state media projects prosperity, the public is filled with despair, believing tomorrow will only be worse.